Technical reserve in non-life insurance with particular reference to motor insurance. At the ASTIN colloquium held in Lucerne, one reported on the request from the Sixth Conference of European Insurance Supervisors for cooperation in the studies being made into the subject of technical reserve in non-life insurance. Copies of notes prepared for the sixth conference were distributed to members, and an advisory committee was formed to assist in dealing with the request. Two reports have been sent to all members of this committee. It hasn't been practicable to prepare further reports, and the present paper set out the current position of the work being done. It will be recalled that in a number of papers I have represented that research into method of determining technical reserve has been severely restricted because of the absence of suitable statistics on which to experiment. This point has been well taken by the European insurance supervisors, and recently suitable statistics of motor insurance on which to experiment have been made available on a confidential basis relating to 6 Swedish, 7 German, 5 French, 6 Italian, and 4 British companies. These returns, whilst not compiled on a uniform basis, provide an immense amount of data not previously obtainable, and it will be appreciated that the analysis of the data is a task of considerable magnitude. I have made certain preliminary studies as a result of which a number of points of detail have arisen which have been referred back for clarification or explanation. Nevertheless, these studies have provided a very useful background to the whole problem, and the present paper is written against this background and of my earlier papers on the topic. Since the detailed statistics are confidential and agreement for publication would mean some delay, only the broadest indication of numerical values are given. Nevertheless, the comments made are based on the studies of the figures for the 28 companies and thus have a considerable practical utility. Before entering on the details of the paper, I must express thanks to the SIG Conference on European Insurance Supervisor for their help in providing the statistic, and to the OECD who are engaged on parallel studies. I was invited to a meeting of a working party of OECD to talk about the actuarial approach, and also to the recent meeting of the sixth conference to report progress on the analysis of the statistic basis of current approach, since the reserve required are essentially an estimate of the future outgo in respect of commitment entered into prior to the end of the accounting period in question. It is necessary to find some method of using recorded fact to provide a basis of forward estimating. This means that a rational explanation must be found for variation shown in the facts, so that some basis exists for carrying calculation into the future. Furthermore, since there will be a variation in the emergence of the future result as compared with the estimate from random fluctuation, it must also be possible to make a reasonable estimate of the distribution of such fluctuation so that an appropriate margin can be determined. It is hardly sufficient as a commercial rule to merely specify a large margin, as this could result in undue restriction on the development of smaller or specialist companies, and also require unnecessarily large capital reserve to be tied up in the business. As a basic principle on which to build calculation, it is assumed that for a homogeneous portfolio in stable condition, the claim frequency rate, a number of claims per 100 cases exposed, will be constant apart from random fluctuation, and the distribution of claims by amount will be stable apart from random fluctuation. It is hardly possible to produce direct observation to prove the validity of these two basic assumptions because of the difficulty of establishing experimental conditions in which the factors affecting the frequency and mean claim remain steady, but all the evidence available points to their truth. It may be observed that were they in fact not true, there could be no rational basis for the calculation of insurance premium. To build on this principle, it is necessary to study the variation in practical condition of these quantities and to identify those factors which give rise to non-random variation. When the non-random variation have been identified, estimate of future result can be made and also the significance of random variation determined. Technical reserve required. The technical reserve required can be classified as follows: reserves for unexpired risk, reserve for incurred but unreported claim, reserve for outstanding claims, fluctuation reserve. In the following paper, the claim component only is first considered. The requirement for first and second are determined by finding the expected numbers of claim and multiplying these numbers by an appropriate average claim. The reserve third is found by multiplying the number of incurred claims in each year by an appropriate average and deducting therefrom the actual settlement to the close of the account concerned. This resulting outstanding is then subjected to certain other checks. The number of claims and the payment are factual figures derived from the company record. The expected average settlement is a judgment figure derived as explained below. The number of years for which the details are required depends on the class of business. For own damage claim in motor insurance, practically all the claim will be settled at the end of the second year, and any earlier claims outstanding could be dealt with on a separate comparison basis. For motor third-party claims, at least 5 years will be needed in this form. Earlier years can be dealt with on a basis of comparing the company estimates at the previous year with the settlement and current outstanding to determine the evolution of the estimate. Certain supplementary statements will be needed to complete the basic summary. These are needed to control the numbers of claims and the distribution of claim settlement numbers and amounts in time. So soon as a few years statement become available, the estimation problems will become relatively straightforward. The various components of the summary are now discussed in detail against the studies of the 28 companies' figures. It is quite clear that there are a number of different ways in which the number of claims is defined, and the important point is to ensure consistency. The treatment of zero claim also varies between companies, probably a reflection of different internal procedures. A major difference in definition arises when two or more claims can arise under a single policy, and there was evidence in some companies of a change in definition over the period of their returns. Consistency in a given company is essential, but either method may be used to treat all claims arising from one incident as a single claim, to treat each claim as a separate item. Method will clearly give rise to a greater number of claims for the same number of incidents as compared with method 1. There will, however, be a rather lower proportion of zero claim and also a lower proportion of part payment. The average claim will also be lower under method second. It is important that the method being used is properly defined and any changes in procedure made clear. The number of claims notified in a year can be considered as the sum of those arising from incident in the account year and those arising from incident in earlier years. In theory, the numbers should be allocated to their years of incident and an adjustment made for unreported claims at the close of the period. Thank you.